Hey everybody, taking a look at the S&P 500 as we get ready to trade March week 5, 2019. So big shakeout on Friday. I thought it was time to maybe clear the S&P 500 chart and kind of go over where we've come from and then get into the finer points of what's coming up this week. So here's our S&P 500 chart backed out for a couple of years, and as we came into 2019, we had the risk that we had a Fed that was going off the rails and was going to ratchet us up into recession. We didn't know whether or not we were ever going to see a trade deal on China, and everybody was saying, that there's no way China's ever going to really agree to a deal, and this is all a bunch of BS. And then we had the whole Russia investigation hanging over our heads, and the idea that we might have a president who gets impeached out of office, especially with a whole slew of new Democrats coming into Congress. And so here we are at the end of, approaching the end of the first quarter of 2019. And instead of coming down here and trading lower, we've instead traded nothing but up from that low that we made in Q4 of 2018, the day after December, when we sort of bottomed out and we've rallied up, and instead we're almost back to within spitting distance of the all-time highs. So keep in mind that those ideas about coming in and trading back here to filling in the last of these gaps that are set behind us, still sitting down behind us back to 2016, that that trade is probably on the back burner indefinitely, because in order to get there, we would have to trade all the way through everything that we've done in 2019, break that, and then head lower. And frankly, look at all the damage and all the money that could have been made if you just stayed short from the high that we made in September of 2018 to the low we made. So there's plenty of money to make on the short side if we even retraced everything that we had here and just made a higher low against 2018. So I think the point I'm trying to make is that all of the variables and all of the negative factors that we had coming into the year don't really exist, at least not as strongly as they did back then. So I hope that makes sense. So let's focus on what's happening here and now, the idea of getting back to the all-time high and seeing if we can make a new one. And if we can't, the idea that we're going to retrace some, if not all, and backtest all the way back to this low here at some point in time. And then if this ever breaks, then we can revisit this story down here. But for me, I'm kind of putting this away for, indefinitely. I'm still interested in buying puts, every once in a while that go out a month, that maybe think about retracing back down here into these lower levels that we've made so far on 2019. But as far as the ones, the idea that we're going to have this huge payday someday of this big trade all the way back to maybe 2000 flat, I don't know about that anymore. I mean, it may come someday, but I'm not really counting on it for 2019. Anyway, let's get back to what's going on here in front of us. So what we've traded so far is all the way back to the beginning of our story, from where we fell off the cliff in 2018. And when we take a look at that, this is that day. This is that fateful day of October 10th, 2018, where we gapped open down below the 50-day simple moving average. We traded down and we bounced around on 2850, between 2850 and then we started doing a little dip below 2850. And then Art Cashin came on and said some things about what was going on in the currency markets and the bond market. It's kind of like the flavor of what was happening on Friday, because they're saying that the big catalyst for why Friday rolled over was the inversion of the yield curve, and coupled with all that negative industrial data that came out of Europe in the early pre-market at like 4 a.m. The whole market just sort of rolled over all the way back then. So we came into a huge gap down to begin with. Anyway, so kind of a similar feeling to what we had going on here. And this turned out to be the beginning of, a horrendous sell-off that went on for the rest of the quarter. And right now, the highs that we just traded back to deal with what was going on in this day here. So when you hear me talk about the 28, 29, 44 level, that's the halfway back of this day. So I hold the cursor here. This is like 28.30 or so. You see that's the halfway back point of the huge range that was made on this day. And that 28.46 level was that level where things just sort of, the bottom just fell out of nowhere in the middle of the day. It was right around the time that just before the bond market was going to close, and we just fell, and we literally tripled the range down on the day. And it's been a long time since I saw a day like that. And Friday, like I said, had a little bit of that feeling, and it's interesting that we've just been trading back to these levels over the last couple of days that we had traded back in there. So with that said, we could see that if we were to just take the range of the last couple of days that we've traded on Thursday and Friday, and if we just took that and doubled that down from where we ended the day on Friday, if we came in and if we gap down, or if we just come in and fall down through the 20-day simple moving average, you could see a real easy symmetrical move that we can make here where we just double down the range of the last 2 days. And in doing so, that would take us down here. It would take us down filling one gap, two gaps, three gaps that we have in our wake. It would put us down through the 200-day simple moving average, but it would hold us above the 50-day simple moving average, and it would hold us above the March low. So I think that's kind of an interesting thesis if we do push it a little further. I don't know if it'll happen on Monday. Maybe Monday we get a bounce because there was nothing in this report with the president. It doesn't look like there's going to be any indictments or anything further for now. Maybe we get, and everybody probably went home very short on Friday. You got the whole full bus syndrome, where too many people on one side of the boat, so they're going to rock the boat and push things the other way. And plus we have Apple on Monday. So if we don't get it on Monday, think about maybe Tuesday, Wednesday that we come back and maybe fulfill some sort of like a move like this. And then I think though also by the end of the week we will recover because we have the LYFT IPO coming our way. And it really seemed to have a lot to do with what was going on here on Thursday. It seemed like the market was waiting. The market came in sort of overly short from the Fed, the little sell-off at the end of the day after the Fed on Wednesday. And so the market was overly short, so you got a good squeeze going on in the morning. And then that IPO came on for Levi's, and the market just kept on rallying and squeezing further and rallying on up to our new and current 2019 high. And then all the stuff that happened overnight on going into Friday, and we did this big gap down open and blah 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 and sold off from there. So if we could get that much juice out of the market from the Levi's IPO, I can only imagine what the LYFT IPO on Friday could do for the markets. So we got Monday with Apple and their event and maybe an overly short market. And then on Friday we have the LYFT IPO, but everything that's going on in the middle of the week, people are away on spring break. I bet the volume is going to be a little thinner. The market's going to be a little easier to push around. And it's the last week of the quarter. So I have a feeling it's going to be pretty choppy. But keep this idea in mind, but also keep in mind that by the end of the week, we're probably going to be rallying back. And I would be very, very surprised to see us close out the quarter below either the 200 or the 50-day simple moving average. If they want to close out the quarter below the 20-day or even the 10-day, who knows if even that's something they even want to do. So, we'll see. We'll see how that goes. I hope this is making sense. I hope I'm not jumping around too much on you here. But here's the roadmap that you usually see with all of the, the specific levels all mapped out for you. Our 10-day simple moving average, our 20-day simple moving average. Our March halfway back is right in here too, right here in line with the filling of this very next gap down. So if we do have only just a little bit of downside to start off the day Monday and then bounce off of that and rally back a little bit, keep in mind here that here is the March halfway back. So maybe on first approach, that's going to hold us up and we bounce from there, get Apple out of the way, see what they've got to offer, see if that's got something in it that's going to rally the market. It never does. It's always a sell the news thing, but you never know. And then later on in the week, maybe we come down and we break the March halfway back And once we break the halfway back point of something, we tend to we tend to revert all the way back to the low of that range, which would be this low here, the March low, and that, like I said earlier in the video, that rhymes with this double down idea of doubling down the range of these two candles here. And that would take us all the way down here to fill this last gap, test that 50-day, test the March low, fulfilling the halfway back, fulfilling all kinds of different rules. And one other thing too, if we want to talk about the 80 handle rule here, on Thursday, our high got to 28.60. Okay, and our next level up from there was a gap overhead at 28.80. So really, this was just right before your very eyes, seeing the 80 handle rule play out. And then on Friday, we gapped down, open just below 28.50. Frankly, we gapped down just below our 28.46 50 level. Explained earlier in the video what that's all about. And we traded all the way back down to 2,700. Our low for Friday was 2,800. I'm sorry, 2,800, not 2,700. 2,800.47, holding the 20-day simple moving average. So you can think that if we're going to break 2,800, we got to go to 2780. At 2780, we have this second gap in here. So that would be your break of the halfway back from March, and holding this gap here at 2783. There's your 80 handle rule, and if that breaks, we go to 2760. And when we roll back down to 2760, you see here's the halfway back of March 11th. That's this huge range here on this candle. And if that goes, then we go to 2750. That's where our 200-day is, and that's where gap support to this next gap below us as well. So lots of rules here that we can use and incorporate. It's pretty textbook, everything that's going on. Choose whichever rule works best for you to help remember where you're at. That's really the most useful tool for them. It's not so much remembering a level precisely. It's just sort of having a guide of, if we're at 2,800 and we lose it, we should probably prepare for 2780. So when you're buying puts, maybe you want to focus on, that goal there. And that if 2780 goes and we're going to go to 2760 or 2750, that helps you sort of focus on what strikes of puts you want to, go after. So anyway, I hope that all makes sense. I don't want to ramble on for too much longer here. Have a good rest of your weekend. If you have any questions about anything in this video, just send me a DM. Have a good rest of your weekend. Good luck and good trading.